What's up everybody, Andrew here. Welcome back to the channel. As you know, we are all about that easy money. And today, we're gonna dive into the easiest way to increase your wealth by sharing with you when, how, and where to invest your money on this edition of Easy Money. I think anybody that is interested in their finances or increasing their wealth is also wondering about investments. What does investing even mean? Simply put, it's expending money with the expectation of achieving a profit. As we've discussed before, this could be investing time into your personal education and knowledge, which you're doing right now this very second, so good job on that. Or it could be investing your money into something that could increase in value. Either way, it's all about increasing value. When should you invest? I get this question a lot, and the answer is simple: early and often. You need to be investing as early as possible and as often as possible. When it comes to investing, time is your biggest asset. $1 invested at age 20 years is worth $5 of investment when you're 35 years old. The sooner you can begin investing, the better. Whether that's a financial investment, educational investment, or just investing in yourself. Here's a quick example of why you should start early. We have two investors. Both of these investors will invest $2,400 each year they invest. Investor 1 invests for 9 years, from 21 years old to 30, investing a total of $21,600. Investor 2 doesn't begin investing until the age of 30 and continues to do so for 38 years, investing a total of $91,200. Both hold their investments until the age of 67 when they cash out. Investor 2 invested a total of $91,200 and at the age of 67 matured the investment to a whopping $1,483,033. That's not too shabby. But here's where we introduce time. Investor number 1 only invested $21,000 but started at the age of 21, 9 years before investor number 2. And because of this, investor number 1 grew their investment to an incredible $2,547,150. Those 9 years allowed investor 1 to not only invest 25% of what number 2 did, but also allowed him to make over $1 million more in their investment. Time matters. Time makes a huge difference. Invest early and invest often. I know what you're thinking.
Well, that's great and all, but I don't have an extra $2,400 per year to invest. That's why investing is a rich person's game and not for me.
You're right. The money does have to come from somewhere, which is why budgeting is so important. You can check out my video on budgeting here and see where you can get the extra cash to invest. And before you throw money into investments, you must be sure to have your finances in order. Pay down your debts, have 3 to 6 months living expenses saved up. With that said, you don't need a lot of money to invest. It's more important to be consistent and to start than to have lots of money to throw at it. Even $25 per month from the age of 21 to 67 adds up to $100,000. That's you putting in $13,800 and growing that investment to almost $100,000. You should strive to get yourself to the point you can invest 20% of your income into investments. I know that might seem like a daunting task. Just take small bites at it over time. Maybe start with 1 to 2% and increase it. I've found that the easiest way to find that extra money is when you get a raise or pay off a debt. Instead of increasing your cost of living and buying more stuff, utilize that money to grow your wealth. Take that 5% pay raise and use all of it for investing. It's really easy to take advantage of that right when it happens and you haven't felt the increase in living. Or perhaps you pay off your car loan and now you have $200 extra every month. Immediately start paying that $200 to yourself. Invest it. Now you can have that $200 building you wealth through interest instead of you paying interest out to the debt. But don't put all of your eggs in one basket. It is very important to diversify your investment portfolio. That way you protect your growing wealth from uncertainties in the market. If one investment goes bad, you only lose a small percentage of your overall portfolio. Remember, we can research all we want, but at the end of the day, no one has a crystal ball and we don't know the future. Where does one invest their money? Well, going back to the definition of investing, you put the money into something you feel will increase in value. There are thousands of things you can invest in, but most investing fall into these categories: commodities, currency, stocks, and real estate. Commodities are physical, tangible things that you hold. This could be collectibles like Pokemon cards, watches, gold, silver, anything you can touch. For most people, this is more of a hobby. Many of these types of investments can be long shots, especially if they're collectibles. I wouldn't put a large percent of my portfolio into this, but it can be fun. Personally, I have a few collections myself, but in total, I probably have less than $2,500 in commodities. Currency has always been a market for investors. With different economies and systems backing currencies, you can buy and trade and increase your value. This is especially true when it comes to the cryptocurrency market. The fact that it is in its infancy allows for a lot of opportunity for newer investors to get in. This is a very volatile market though, and I don't recommend investing more than 1 to 2% of your portfolio into cryptocurrency. No matter where you decide to invest, be sure to do your research. Educate yourself on how those markets work, whether it's learning the characters of Pokemon, understanding the blockchain, or figuring out the bonds market. Do your best to understand how it all works. The more you learn, the more you earn. Most people, when they hear the word invest or investor, they immediately think of Gordon Gekko trading on Wall Street. And rightly so. It's one of the most prominent places to invest, the stock market. Have you ever wanted to own a part of Disney or Tesla, maybe be an oil tycoon or help solar power grow? The stock market allows you to do that. You're literally buying small shares in each of these companies. There are many ways to invest in the stock market. The best ways to start are through your 401k, IRA, or HSA. All three of these accounts let you invest your money into the stock market on a long-term basis for retirement. If your employer has a matching 401k, that is free money right there. I highly recommend you participate in that. Most 401ks allow you to modify where the money is being invested, and they make it pretty easy to get involved. It also takes the money from your paycheck pre-tax, so you only pay taxes on the money you earn, saving you a few bucks now. An IRA is also a retirement account that allows you to invest in the stock market. You can start an account through brokerage firms and retirement companies, or you can build one yourself on apps like M1 Finance. That's where my IRA is. The tax savings of your IRA come after you retire. You can invest up to $6,000 per year, and after you retire, you pull all the money out that you've earned, free from taxes. An HSA account works in a similar fashion. This is actually a health savings account, so you can put in pre-tax money that can be used for any health-related or medical items, from doctor bills, medicine, mental health care, and more. Once the account is $2,500 or more, you can begin to invest that money into the stock market to grow your wealth. And when you retire at 65, you can take the money out penalty-free. Once you've got one or all three of these accounts going, then you can invest in the stock market in many other ways. The final investment we'll talk about here is real estate. There are so many facets to real estate, but ultimately, this is another great place to invest your money. Not only will the property increase in value over time, but you can rent these properties out and earn passive income as well. One of the best ways to get involved in real estate is to house hack. This is where you buy a property you can live in and either rent out rooms or units if it's a multifamily property and use those rents to cover the mortgage. I really wish I had known about this in my early 20s. I would have bought a 3-bed, 2-bath house and rented out 2 rooms, and I would have lived rent-free. Once I decided to move on, I could continue to rent out that property, move into another, house hack again, or purchase more rental properties. I could make an entire video series on each of these investing categories. The key here is to invest early and invest often, and diversify your investments. You don't have to have thousands of dollars to get started. Go to your employer. See if you're participating in the 401k. Ask HR if they match and how much, then take advantage of that. See if there's a health savings account you can take advantage of. Many times there are things you're already doing, and with a slight shift, can change that liability into an asset. I really appreciate you, and I love that you made it this far in the video. Be sure to tap that like button and subscribe so you're sure to never miss out on any easy money. I'm Andrew. This is Easy Money. And now it's time to invest in yourself.